Welcome back, traders and investors. The second week of June was pretty volatile. What started as a promising week with RBI's dovish policy support ended in chaos as geopolitical tensions erupted, wiping out 5.94 lakh crore rupees in market cap in a single day. If you held Indian equities during June 9 to 13, this analysis will help you understand exactly what happened and what comes next. The Sensex crashed 823 points on Thursday alone. Oil prices spiked 8% and the rupee swung wildly against the dollar. Yet, beneath this surface volatility, institutional flows told a fascinating story of domestic resilience versus foreign fear. Let's start with the numbers that matter. The week began with optimism but ended in turmoil. Nifty 50 closed at 24,718.6 on Friday, down 85 points or 1.14% for the week. The Sensex fell 1070 points to finish around 81,118, marking a weekly decline of 1.3%. But here is what made this week extraordinary. The intraday volatility was extreme. On Thursday, June 12, the Sensex swung an incredible 1,138 points from its daily high to low. The Nifty touched a weekly low of 24,473 before recovering slightly. India VIX spiked 13.9 to 15.97 on Friday alone, the highest jump since May 8th, signaling massive uncertainty. Bank Nifty was particularly brutal, falling 555 points to 55,527 on Thursday, with all 12 banking stocks ending in red. The market breadth told the story of broad-based selling. 43 out of 50 Nifty stocks declined on Thursday, with only 783 stocks advancing versus 2,112 decline across NSE. Friday, June 13 became a day traders won't forget. Israeli airstrikes on Iranian military and nuclear targets triggered a global risk of stampede. Iran's retaliatory ballistic missile launch towards Israel sent shockwaves through energy markets worldwide. Brent crude oil exploded 7.62% to $74.23 per barrel, while WTI surged 7.02% to $72.98. This wasn't just about oil, it was about the Strait of Hormuz, through which 20% of global oil transits. Iran's threat to close this critical shipping route had traders pricing in supply disruption premiums. Despite the chaos, two sectors emerged as clear winners: IT and healthcare. The IT index gained an impressive 3.15% for the week, benefiting from safe haven flows and expectations of rupee weakness boosting export competitiveness. Healthcare added 1.53%, marking its second consecutive week of gains as investors sought defensive plays. On the losing side, FMCG led the decline at 2.29%, hurt by rising crude prices threatening input costs. Banking followed at minus 1.86%, with heavyweight HDFC Bank falling 1.33% and SBI dropping 1.57%. The auto sector's 1.41% decline reflected concerns about higher fuel costs dampening vehicle demand. This sectoral rotation revealed a clear flight to defensive export-oriented sectors while domestic consumption plays faced pressure from energy inflation concerns. This week showed Indian markets' vulnerability to external shocks but also highlighted the growing importance of domestic institutional support. For active traders, focus on defensive sectors and watch key technical levels. For long-term investors, any sustained weakness could present attractive entry opportunities in quality names. The market has weathered the initial geopolitical storm. The question now is whether the calm that follows will bring opportunity or further uncertainty. Keep your risk management tight and stay alert to this evolving global dynamics. That is your comprehensive wrap for Indian markets for June 9 to 13, 2025. Stay invested, stay informed.